Hello everyone, I'm Ted Oakley, Managing Partner at Oxbow, with our quarterly but also our year-end call. And some of the themes you'll hear us talking about today is obviously we've written about it the last few days. Complacency is very high. You'll see some mixed signals in the economy. Some things are doing okay, some things not doing okay. And you're seeing a lot of things happening for us watching what's going to happen. We have a new policy group coming in. What are they going to do with tariffs and immigration, government employment, a lot of things that factor in. And then there's a lot of upheaval worldwide. We just had the Prime Minister of Canada step down. We've had South Korea's having trouble now. It's already happened in Argentina, but if you look at UK, France, Germany, this is happening all over the world right now. So there's a lot of things going on, and for these reasons, I think there's more going on right now than there has been in a long time. We're still keeping a fairly large buffer in treasuries, and we're keeping most of our bond maturities short. But having said that, if you go look at the economy, I'm going to start off with the number one thing I think that this group in Washington will probably have to deal with is the debt situation. If you'll notice here, our interest payments on the federal debt now are $1.1 trillion, and you can kind of see what's happened here in this most recent run-up. The problem about that is, and that could be the real fly in the ointment, it was just real interest rates are moving higher. And when you have the government debt as a percentage of GDP, which is what we produce as a country, get up to 120%, historically, that drops your growth rates way low, down to 1%, maybe 1.5%, sometimes 2%. And so we live on what I consider to be borrowed time in terms of how much growth we can really get out of the economy. The other thing we've been watching, and it just can't get any legs, is the housing market. Now, if you look at the Case-Shiller index here, it's still increasing, but that increasing rate, if you'll notice, has been falling for 3 years now. And so prices are still up. But one of the problems is that people are spending a third of the money they have on insurance and taxes. And we've said all along, it's not just the interest rate. The price is too high. So if you buy a home, you're going to have to come back in with taxes high, with insurance high. That's one of the problems. The other thing we watch quite closely, and it still continues to rise, is the U.S. office vacancy rate. It stays high, and it looks like it's going higher. We're just not getting a lot of traction there as well. So if you look at another thing, and this just happened really in the last few months, we started to see credit card defaults really rise quite a bit. They're the highest they've been now since really in 15 years that they've gone up. So that's the beginning of what we're going to see is maybe a pinch on the average consumer. Commodity-wise, it's been a mixed bag. I mean, we've had some metals that went up during this past year. We've had some soft commodities that went up, some soft commodities down. Beef's high, cocoa's high, but other things are lower. So you can see, but the commodity index, one thing I wanted to show you, since in the last 20 years, it's done nothing but go down. And so we feel like over the next 10 years, there'll be more periods where you want to look into commodities and commodity-based companies to see what they can do. The last thing is gold had a good year this year. We had a good year with our gold. It was up almost exactly the same as the S&P 500. Most people wouldn't tell you that or talk about it because they keep talking about these big name stocks. But gold had a really good year this year. We feel like it'll continue to go through. Now, if you look at the bond market, one of the things that's happening there is individuals, we find this interesting, they keep pushing into bond funds. And bond funds, typically, the average bond fund buys more long-term bonds than short-term bonds. We're just the reverse. We're buying a lot of short-term bonds, treasuries primarily, by the way, less than 2 years, but not many on the long run. But individuals keep, and I think a lot of that comes from the advisors that keep going back to the old school 60-40. You have to own some bonds. But the bond markets haven't been good. I mean, if you look at the 10-year return this year, total return, it was actually a shade negative, but they keep pushing into it. One of the things that people don't realize too, we've seen a lot of buying into high yield, and I know people say, well, it's time for high yield, but I wanted to, if you go across the bottom axis here, you'll see the different ratings of bonds. And the lower you go down toward the triple C, when they first come out, they'll show you, for example, the black line that, hey, this is a great yield, and et cetera, et cetera. What they don't factor in is the default levels, the things that could go wrong with this paper. The bottom line is what you, over time, you've eventually ended up with, which tells you that to take the risk of owning that really, really low-grade paper is not that great an idea compared to where you would be in the top 2 or 3. That's one thing to keep in mind. The other thing to keep in mind is individuals, they have short memories, but if you look, for example, back in 2020, Austria issued this bond, which was a 0.85% yield. It was a 100-year bond, and they sold these bonds like crazy. That bond today is down about 57%. Apple, a few months later, issued a 2.55% bond, a 40-year bond, and it's down today about 40%. You have to be careful with long-term paper. It can really affect you, the principal. And I think people are forgetting about it today. If we go through 5 years of higher interest rates, in general, it may go short-term low, but in general, if it's higher, they'll pay the price for having invested in those. The biggest thing I'll talk about today probably is the stock market, because I think it's really gotten to that point to where people are just totally engrossed in it in every way possible. And all the speculative activity, we see all age groups, from teenagers all the way to people in their 80s that have a lot in the market. And you can see here the average financial mix for people in the U.S. today is 71% stocks. They have hardly any bonds, and they have some cash, but that cash is not necessarily meant to go in the market. So what we're seeing is people is totally exposed to that. And on top of that, if you look at this past year, and the dark line on the right is November. We had more money come in, one of the biggest months we've ever had, actually the biggest month that came in November. December was right behind it. So people kept pouring money into the markets here. They didn't really stop to think about where we were. And if you look at foreigners, they own the same things. They own the big 7, the big 10 stocks that are in the U.S., and most of their indexes are 2/3 of these big U.S. stocks also. So everybody's in the same thing. And we're looking now, like if you take the U.S. market, which is, by the way, this blue line, the capitalization of that market, and you take all the rest of the world, the non-U.S., okay, it's even now, even money. So just stop and think about that. Do you think this U.S. stock market is equal to all the rest of the world combined? It doesn't make sense, but that's what we've done. We've driven these averages up so high. And over the last 10 years, if you look, the U.S. has had a much higher return, 3-to-1 really, over these other countries. It's been something that you look at and you think, well, that probably can't continue to exist, and we don't think it can over time because of where we are. And just to remind people, you can go through long periods where nothing happens. If you looked at Nikkei Japan average, and it went from 1990, 1990, it went from 5,000 to 40,000, 8 times, okay? So everybody thought nothing could ever go wrong, and yet it took it 35 years to get back to that level. Same for us, 2000, 2012, 1966 to 1983. These things can happen. I know you're not thinking about it today, but that's where we are. The other thing is there's a lot of unprofitable companies. They continue to be, they live off of debt, and they've lived off of this cheap debt, but that's starting to change now. And if you look, 44% of small cap companies, 44% are unprofitable, not making any money. Even 19% of mid-cap companies. Mid-caps are big companies too, by the way. So we're seeing that happen. And if you look at the top 10 stocks now, they make up 40% of the total 500 stocks in the S&P 500. That just means that you're highly concentrated. And we keep calling this the one-button market because when people go to sell, they'll sell one thing. They'll sell the indexes and they'll sell exchange-traded funds, which are jam-packed with this type of thing. So if you look at these comparison, these averages, now we put this together so you could see it. But if you look at the GDP of the country, we were 17 trillion 10 years ago. We're 29 trillion today. The NASDAQ was 4.7 trillion 10 years ago, and it's 26 trillion today. In other words, it's gone from being 27% of all the goods and services we produce in GDP to 92%. In other words, that set of stocks is worth the same amount of everything we produce with every industry, every real estate, everything in the country, just to give you an idea where the froth is in this marketplace. The other thing that's happening is if you look at it, and I call this one button investing because they just hit one button when they get ready to buy or sell. And that is that if you look at the red line, which is basically passive assets, and that's indexes if you want to get into it, or S&P 500s and that sort of thing, they're basically equal to the same amount we have in actively managed portfolios. The problem with that is everybody owns the same thing. I mean, that's where you are today. Individuals, pension plans, everybody has the same ownership. And that ownership is one thing. It's that sort of thing. So if they need liquidity, they're going to sell that, okay? And that means that everybody is hitting one button to basically sell out of the marketplace. The other thing is, if you take the earnings on the S&P 500 and you flip it upside down and say, okay, what are my earnings yield, what we're making on the S&P 500 to the price, that number is 3.87% right now. And the 90-day Treasury is 4.31%. What we're saying is this: if you don't have any premium, in other words, they're saying, hey, we will actually give you more money to own the risk-free asset than the risky asset. And people are not thinking correctly. Normally, this spread is about 3 or 4 points. In other words, you should be getting an earnings yield on the S&P 500 that's 3 or 4% higher than the Treasury yield. Right now, it's break even. In other words, people are saying there's no risk in the market. Just to give you an idea, though, we took the last 5 years of true returns in the market and the S&P 500, and these are actual returns, total returns for all 5 years, ending 2024, and said, let's just say, and this is the kind of thing, these markets happen this way. Let's say you have a 40% sell-off or a 50% sell-off. This is why we say you want to miss these big pieces here. They can hurt you. It's because if you had a 40% sell-off, you're 100% invested, your average return over those years now goes down to 2.8%. And if it's a 50% sell-off, you go negative. In other words, you give up everything that you made in that 5-year period. That's why it makes sense to be balanced and have some balance in what you do so that you don't get completely locked into nothing but the stock market. So let me give you some ideas about some things that we've been doing. I mean, these are things we've been doing during the quarter. We think if you look at the stock side, you know, if you look at Novartis, a pharmaceutical, and Suncor, those are two. We own some foreign companies now. They're a lot cheaper in some respects. Both of those are foreign. Good ideas. We own a lot of energy. ResMed, though, here is in healthcare. And we own Conoco, bought during the last 4 months. Good management. We feel like that they will come through. We own a number of energy companies. We don't have them all here, but we own a number. And we feel like that portfolio is structured the way it should be. If you look at the high income portfolio, Boeing, when they got in trouble, came out with a convertible preferred stock, which we own. We've got a 3-year look at Boeing now to see if they turn it around. In the interim, we get 5.5%, 6%. That's the kind of thing we like to do. We already own Northern Oil and Gas. We like the gas market, natural gas. They had a 4.40 yield. And then UGI, which is really a natural gas and electric utility combination, has some propane. They have different things, but they're a 5.25 yield. And then we have a couple of foreign companies who bought LyondellBasell. And you'll say, well, why would you buy a chemical company? LyondellBasell has always paid a good dividend, but they trade in a range. Like, for example, this stock was up 106, and I think it's around 73 or 74 now, 7.4% yield or so, roughly. Same way with Rio Tinto. This is another foreign company. It's good metals company, a lot of iron, different things that we want to be on the commodity side, great yield. And then lastly, and we have a lot of this, I'm talking about in all three strategies, we have a lot of the floating rate and short-term treasuries. We feel like that's what you should have in this period. So to wrap it up, I'll say this to you in closing out. You need to really think about what you own and know, again, what you own today. You don't want to take somebody else's advice. You don't want to be chasing these high-flying stocks. I know they go up in price, but there's a difference between buying a company that's a good company and buying a company at the right price where it's a good buy. We've seen over the years a lot of good companies, so to speak, really go down a lot in price. We feel like there's a number of those out there right now. But one of the things we're going to see this year is you got a new administration, new ideas, a lot of things coming in. And I don't think any of us have the ability to figure out what that's going to do to all the marketplaces, which means that you need to keep, in our opinion at least, some ability to have some movement if you need to. And the only way to do that is have some liquidity, we think. Stocks are priced to perfection. If you look at the multiples on these companies, there's only been basically 3 times in 150 years that you've had the prices as high as they are today. And everybody can say, well, you know, but there's reason, AI, whatever you have. It's always the same story. I've been here a lot. There's always a story as to why they're there. But in reality, it's what makes sense to buy if you're buying a company. On the interest rates, maybe we get in trouble and the Fed comes in and lowers interest rates in the short term. They very well could. But as our advice to you is don't take that bait. In other words, keep your maturity short, even if the rate comes down a little bit, because later on we think they go up again. And we think we're just in this cycle of higher rates in general. You need to keep it in mind, because the short term may be okay. Long term bonds we don't think is where you need to be. And the last thing, this is a time to keep some peace of mind money. Try to keep some money so that no matter what happens, whether it's good or bad, you may be participating. But if you've got some balance in your portfolio, I think you'll find you'll sleep better. You'll have a better look this year than some other people. It's hard to come back after 2 big years and expect to have a third one back to back. So that's kind of where we are. Thanks for watching in, but I would say to you, if you want more information on this, or you want to talk to anybody, or you want to see something, come and visit us at the website. It's oxbowadvisors.com. And for that, I hope to see you next quarter. Hello everyone, I just want to say, if you like this video and you want to see more of this type of information, because we really try to get the information that you don't see from anybody else, then be sure and click on subscribe and you'll see more of what we do here at Oxbow.